What's up, everyone? Welcome back to our channel. Brad Cohen with Connexa Real Estate here to keep you in the know about what's going on with real estate in Harrisonburg and Rockingham. I received a message from my friend Bree expressing some frustrations about the housing market and looking for some guidance. She writes, "Brad, explain to me why houses are a gazillion dollars more than they should be right now and why interest rates are so high, and when can I expect this to change?" So today we're diving into the hot topic that's on everyone's mind. Why are house prices in Harrisonburg so dang expensive, and what's the deal with these high interest rates? Before we jump in, please like and subscribe to keep updated on what's happening here in our local housing market. I also publish content about real estate investing, marketing tips for your business, Harrisonburg specific projects, and whatever questions I get from you. Okay, cool. This is a loaded question with a lot of background, so let's get into it. First, let's talk about these sky-high house prices. The simple answer to why prices are so high is supply and demand. The main culprit here is the limited housing inventory. The demand for homes has significantly outpaced supply for several years now, causing prices to surge. If you look at the historical context, it really helps. From 2011 till 2014, we only saw very modest increases in home values, around 2% per year. Then, from 2015 to 17, we started seeing more steady increases, around 4% per year, while we approached a nearly balanced market between buyers and sellers. Also worth noting that this rate of appreciation in values throughout the whole time period was still lower than the national and historic average for real estate, which is typically around 6% per year. 2018 through 2019 was when inventory levels really dropped and remained low, causing more rapid increases in price. And then COVID hit, causing the craziest housing boom that we've seen since the housing bubble in the early 2000s. Now, I've kind of used the term black swan event to describe this period, which essentially means when something happens that never could have been foreseen or predicted and was driven by several complex and intertwined factors. Demand for housing skyrocketed because people were spending more time at home, and when you're in your house all the time, you'll notice things that make you want to move, things you don't like about it. Migratory patterns changed with people being able to work from home, bringing an influx of new people to our market from DC, Northern Virginia, and the Northeast. And interest rates were the lowest that we've ever seen in history, and quite possibly the lowest that we'll ever see again, artificially creating even more demand from occupant purchasers and real estate investors alike. Now, I've always said that our market has lagged behind the rest of the real estate market, and the data reflects that. But that's also a contributor for why people feel like the run-up in prices over the last 3 years is even more dramatic. Context matters. To go from averaging 4% per year appreciation or less to over 10% is a huge jump, especially in an area where in the not too distant past, you remember when you could reasonably buy a nice single family home for under $300K. Now, those are basically non-existent. So, Bree and everyone who's experiencing frustrations with prices, I get it. Now, let's talk about new construction. If supply and demand is the fundamental reason why prices have gone up, and inventory levels have been the primary issue, why not just build more houses? Good question. And we have been, but again, historical context helps to understand how we got here. From 2008 to around 2014, we saw a much lower rate of new housing projects coming to market. Builders and developers were nervous and scarred from the bubble collapse. Buyer demand for housing was low. Things did start to pick up as demand increased, but there's also that whole it takes time to build a house thing, and the pace of construction and new housing starts couldn't meet demand. This happened at a national level as well as here in Harrisonburg, and COVID made that worse with supply chain and labor issues driving costs up. Those issues have lingered through today, and the cost of building materials has gone up even further, making new constructions more expensive than ever. Remember when a new construction townhouse was in the low 200s? I do. I bought my first house back then. And now we're lucky to build them at cost for the low 300s. Yikes. That's the thing about inflation. It's like a ratchet. Once it goes up, it's really hard to get those costs back down. Next, we have the interest rates. They're high. There's no denying that. People still remember rates in the not so distant past at 3 to 4%, even though that was probably a once in a lifetime event. When rates were at 5% and climbing, we didn't think they could get this high, and there's still a possibility they could get worse before it gets better. The rapid rise in interest rates in such a short period of time hits hard. Notice the motif of context matters? But there's a good reason behind it. The Federal Reserve raised interest rates as a strategy to combat inflation, which went absolutely nuts coming out of the COVID era, and housing was a contributor to that. How fast they raised rates up is a discussion as to whether that will ultimately be good or bad, but it was necessary to cool inflation. Grim economic outlook for the next 12 months would argue the latter, but that's for another video. While really high interest rates might not be great news for those looking to buy a home right now, it's a necessary step to ensure long-term economic stability. Wait, but shouldn't these higher interest rates and outrageous monthly payments be putting downward pressure on prices? Why aren't prices going down? Answer, yes and no. In theory, yes. High monthly payments cut down people's buying power, which should put downward pressure on sales prices. However, it depends largely on the seller's circumstances. If a seller has a low monthly payment and doesn't have to sell, they likely won't take less than what they believe the house is worth. Contrary to that, if the seller is relocating and really needs to get rid of the house, they might price lower to entice more buyers. But we still have an inventory issue, and thus far we're really not seeing that at a high enough frequency to combat the supply and demand imbalance. This is causing what we call price deceleration, when the rate that prices increase slows down, not depreciation where prices actually go down. So when can we expect things to change? Well, it's hard to pinpoint an exact timeline. The real estate market is influenced by numerous factors such as the economy, inflation rates, and government policies. However, history has shown us that the real estate market is cyclical, and these high prices won't last forever. Inflation has seemingly gotten under control, although not quite at the Fed's target rate, and more homes have been coming available in our market. So hopefully, we can expect to see a stabilization in prices and interest rates. Right now, we're seeing a return to normalcy, where home prices are appreciating in line with historical averages. It may take several months for it to truly show in the real data, since real estate is lagging data, but it is happening, and it's more pronounced in different segments of the market, i.e. the move-up market. I do not believe that we will see true price depreciation in our area, and it could take 12 to 18 months before we really see mortgage rates come down. My best guess is that we'll see relatively flat to modest appreciation in home values as we move into next year, and it could be a slow couple of years for value increases while wage growth in our area catches up with the overall cost of living increase. But who knows? It's very hard to predict. What I've been telling people lately is to marry the house and date the rate. If you truly have a need to move and you find the right house, as long as you can stomach and afford the payment, make the move and plan to refinance down the line if or when rates drop. To wrap things up, while the current real estate market in Harrisonburg, Virginia might be challenging, it's important to remember that this will not last forever. In the meantime, if you're considering buying a home, make sure you work with an experienced real estate agent who can help guide you through the market and find the best possible deal. And if you're a seller, the crazy market we've lived through is behind us, so make sure you are up to date on current market trends. There are opportunities in this market for both buyers and sellers, and I'm here to help. And that's it for today's video. If you found this information helpful, please make sure to give this video a thumbs up and subscribe to our channel for more real estate insights. Thanks for watching, and we'll see you on the next one.